So 5 simple formulas. I like to start out with this analogy of 2 boxes, and comes from a presentation that a gentleman named Bob McDougall used to do. He was the first real estate broker that I worked for when I got my real estate license. And he put it in the really succinct, easy to understand terms. If you think of a rental property, whether it's a single family home or a 10-unit apartment building, think of it as a box that spits out money every month. And that's essentially what it is. It's much more complicated than that, but from an analysis standpoint, you can really boil it down to, well, how much money does that box spit out every month? So if the yellow box spits out $800 a month, and that should say box 1, and the green box spits out, sorry, I have to move something, $1,200 a month, which one would you buy? So Stan said, you don't know enough info yet. Todd said box 2. And Daryl said, well, if I had more info, maybe the $1,200 box. And that is the natural inclination. Buy the one that produces the most money or spits out the most money. But what if I told you the box 1, the yellow box, we said it spits out $800 a month, but it has $200 a month in expenses. So now that changes our equation a little bit. It's only producing $600 a month net, or $7,200 a year. However, our green box only has $366 in expenses, but on more income, so it's got a net of $833 a month, or $10,000 a year. So now which one do you buy? So most people now are saying box 2, but there is a huge piece of information that we're missing, and Stan just nailed it. We don't even know how much they cost. And so the income of either one of these boxes is really only relevant in terms of analysis as it relates to the cost. And that really is the crux of the first formula that we're going to talk about, and that's the capitalization rate. We only care about the income as it relates to the cost. And there we go. Now we see some prices, and now we can complete our analysis, or at least we have the information that we need to determine which one is the better deal on the surface. So if the yellow box is priced at $72K and spits out $7,200 per year, that's easy math. That's a 10% cap rate. And then the green box over here is priced at $150K with $10,000 a year net income. Now, which one do you buy? So yeah, generally speaking, given what we know so far, the yellow box appears to be a better deal because it's a 10 cap, whereas the green box is a 6.6% capitalization rate when you take that $10,000 a year, but it costs $150. Now, you can go deeper and deeper into this analysis because we also don't know if the yellow box is a money pit or a Class D property. For example, it might need $50K worth of rehab, and that kind of changes everything, whereas the green box could be a completely renovated turnkey property. We don't know those details initially until you get into due diligence. But it can obviously change which property makes the most sense when you really get into the deeper analysis, even beyond income and expenses. But when you're initially looking at a property, you just see a listing and you want to figure out whether it's worth spending $1,000 on home inspections or flying down to Florida to look at it. The financial analysis of the income and expenses really is key in making that decision. So the first formula, we kind of just mentioned it briefly, is capitalization rate. It is the net operating income as it's compared to the acquisition cost, like we talked about. It tells us the actual performance of the property when you factor in all of the operating expenses. The formula is simply the net operating income, or the NOI, divided by the acquisition cost. In some cases, you could use value instead of acquisition cost, depending on why you're using this formula. But it is a core metric for real estate investors and for all investors, really, because you can apply this to different types of investments. But it looks at the actual net income as it compares to the purchase price or the acquisition cost. Now, this trips a lot of people up. What does it not include? It does not include debt service. Debt service is not an operating expense. You do not require debt to operate a rental property. Debt service doesn't affect the performance of the property in terms of cap rate. The rent, the income is still the same, and the cost is still the same. So the debt service doesn't change the cap rate. When you take out a loan, you're really just pledging your property as collateral for a loan. That in and of itself doesn't change the performance of the property. So when you talk in terms of cap rate, you're assuming a cash purchase. Now, debt service is still important. I don't want to gloss over that, but we'll talk a little bit more about that when we get into some of the other formulas. Go ahead, Todd. You can take yourself off mute and go ahead and ask your question, Todd.
Yeah, I'm just wondering if there's any kind of standardization of what is an operating expense, because I see it's all over the place. For instance, property management, is that an operating expense? Or say that when I do my balance sheet, I put in a cost for LLC. Is that not, I mean, it's an operating expense for me, but would that be included in like a pro forma cap rate?
Yeah, in my opinion, and in what I assume is the standard definition, anything that pertains to the operation of the property, registering your LLC, your insurance costs, your property taxes, management fees, repairs, those are all operating expenses that are directly tied to your operation of the property. Debt service is not. Debt service is a choice in some ways. It's a way to acquire the property or a way to pull out some equity from the property in a refinance, but it's not required. There are plenty of people that own rental properties free and clear, and they don't require debt to operate the rental property. Now, yeah, you may need it to acquire the property, sure, but it's not an operational function of the property. You don't need debt. So really, debt service is the main thing that you exclude when talking about cap rate. And anything that's tied to the operation of the property, you would include. Now, keep in mind, for most properties that are financed, especially on the 2 to 4 unit residential side, you're going to have what's called a PITI payment: principal, interest, taxes, and insurance. So the principal payment is not an operating expense. The taxes and insurance are absolutely operating expenses, and the interest, while you can deduct that in some ways on taxes, it's really considered debt service, and it's not a direct operating expense. Did that answer your question?
Yeah, it does. I just noticed when I look at a lot of financials, when I'm analyzing a multifamily, some include property management, some don't. Some include pests, some don't. It just seems like it's kind of all over the place.
Yeah, that's not a function of the formula or the definition being wrong. It's a function of, I don't want to sound mean when I say this, but ignorance. Some people don't know that it shouldn't be included. Oftentimes, sellers and listing agents always want to paint a rosy picture of the property's performance. So if you look at an operating statement and it says repairs 0, and there's no line item for management, and there's no line item for property taxes, and there's no line item for repairs, they're missing some stuff. And that's really what we're going to talk a little bit more towards the end when we analyze the property that Jamie picked, about how to kind of fill in those blanks, because you see it all the time. There's blanks. You don't get all the information that you need from the listing agent or the seller. Sometimes it's not the agent's fault. Sometimes the seller doesn't know. As a mom and pop, they haven't kept any records. They just don't know. So I'm not going to put something together that might be false. I'm going to tell you, hey, buyer beware, do your own due diligence. And that's kind of what we're diving into today. Good question. All right, we'll have plenty of time for questions as we keep moving on. So I'm going to jump over to our next formula. And first, I want to go back to the bold at the bottom of my slide on cap rate. What if I don't have all the expense info for a property? And that's a perfect segue from your question, Todd. Well, they're missing, I don't know how much they pay for management. I don't know how much their insurance is. How am I supposed to analyze this property when all I have is the price? And hopefully I know how much the rent is. A really quick way to do that is to use what's referred to as the 50% rule. And basically you take the property's gross rental income. If the rent is $1,000 a month, that's $12,000 a year. Cut that in half, and your net operating income is going to be somewhere close to $6,000, or 50% of your gross rental income. And that's just a formula that plays out time and time and time again when you do these analyses of properties. And that's another red flag to look for if you're looking at a pro forma or what's supposedly the operating statement of a property that's for sale, and you see an expense ratio of 12%. That just doesn't happen in the real world. So what are they missing, or what do they not include in those numbers? So the 50% rule is really simple. Take the gross income or the rents, and we do all this on an annual basis. So you take the monthly rent times 12 as a general rule. Take the gross income times 50% and divide it by the acquisition cost. So that will give you an approximation of the cap rate on the property, and you can use that for just a kind of a quick screening, a litmus test when you don't have all of this information. And then we have the 1% rule. This is a really quick piece of math you can do, which is it's essentially do the monthly rents in this case equal at least 1% of the purchase price. So if you've got $1,000 a month in rent and they're asking $100,000, at a glance, that looks like it should be a pretty good deal, especially in today's market. If you can hit that 1% rule, if nothing else, it definitely bears further analysis. If they've got $1,000 a month in rent and they're asking $500,000 for the property, which is not unheard of these days, you might want to just move on and spend your time somewhere else, because that's not going to pencil out. It's never going to be able to cover all the operating expenses, and it's certainly not going to be able to cover the debt service. So the 1% rule is just a quick, easy piece of math you can do in your head. Does the monthly rent equal 1% or more of the purchase price? If it does, dig a little deeper. If it's close, dig a little deeper. If it's way out of whack, then something doesn't look right, or they're just asking way too much. Now, it wasn't that long ago, 5, maybe 7 years ago, we used to talk about the 2% rule, which is, it makes you chuckle these days. There's no way you could find a property that has 2%, let alone 1%. Right now, 1% is tough to find. The 1% still tends to be a tipping point at which the numbers make good sense as an investment property. And often that 1% rule will kind of pencil out to, maybe a 6% cap rate, which admittedly tough to find right now. But at least at a 6 cap, you should be able to cover expenses and cover debt service and have a cash flow positive property. Now, I'll be the first to tell you, is this realistic in today's market? It's tougher and tougher and tougher to find. It's a needle in a haystack, but my opinion is that it's hard, but not impossible to find. And if you can find a deal that hits the 1% rule, in most cases, barring any major red flags, you might want to snap it up. Like I said, years ago, we used to talk about the 2% rule, and that is just unheard of these days. It feels like the 1% rule is unheard of right now, but I don't see things getting so far out of whack that it becomes just completely impossible. Now, there are other markets. I know California is crazy, and there are certainly very competitive, highly priced markets. You probably won't find the 1% rule in Midtown Manhattan, although with all things going on right now, maybe that has changed. But it's just a guideline. It's just a quick thing you can do in your head to figure out how much time do I want to spend analyzing this property. Now we get into some things that are really used more on the commercial side, but I think they're immensely useful on any property, especially on the 2 to 4 unit residential side. And the reason commercial lenders use these metrics is because they tell you something really important, and they're really good indicators of a property's performance. So debt service coverage ratio, you'll hear it referred to as DSCR sometimes, is essentially net operating income as it relates to debt service. How many times will the net operating income, so after I pay all of my operating expenses, how much is left over to cover debt service? If the debt service is more than the operating income, the net income, you got a problem. Somebody's shoveling money into that property to cover the debt every month. If the net operating income is equal to the debt service, well, then you have a DSCR of 1. So you're just breaking even. That means if you have a vacancy, or you have a fire, or COVID happens and you got a tenant who can't pay their rent, that means now you're in the red if you're not at 100% occupancy. And that's for that reason, most lenders want to see like a 1.3 debt service coverage ratio or better. They might lend at 1.25, something like that. But that 0.25 or that 0.3 above 1 is your wiggle room. That is what gives you a little bit of a buffer when you're not operating at 100% occupancy. So it's a key metric for commercial multifamily properties and mortgage underwriters. They want to see that the property's net operating income can comfortably cover all of the debt service, even when there's a stress, such as a vacancy or something like that. And then a corollary to that is your break-even ratio. And I think this one is useful when repositioning properties, because a lot of the time we're thinking, okay, this is a 6-unit property, but I want to renovate them all. So how many units can I take offline and have, you know, have a vacancy in at any given time, but still cover my operating expenses and my debt service and still break even? And so it's a pretty simple formula. You take your operating expenses plus your debt service, and then you compare that to your potential gross income. And so if your break-even ratio is 80%, it means you need 80% of your units occupied and paying rent in order to cover your debt service and your operating expenses in order to truly break even. If your break-even ratio is 80%, but you're at 60% occupancy or 60% collections, then you're going to have to make up that delta of 20%. So it tells the landlord and the lender what percentage of units must be rented and paying rent to cover all of the expenses. And remember, we're talking about operating expenses and debt service in this case. And so it's a gauge of a property's performance. And then you can apply those stressors such as, well, what if we take a unit offline for 3 months because we want to renovate it? Are we still going to break even or better? And so it can be useful planning those vacancies and things like that.
Yeah, I'm a new person joining this call. This is my first call. So you talked about cap rates, and what is a good cap rate for the Tampa-St. Pete area at this time?
Yeah, that's a great question, because what I didn't mention when talking about cap rates is the other way to use it is to look at what's called a market cap rate. And in single family homes, we're typically looking at comparable sales. How much did that house sell for? How much did that house sell for? Well, that tells me how much this house will sell for. Multifamily properties are a little bit different, and you're really looking at comparable cap rates. So if that property sold at a 6 cap and that property sold at a 6.2 cap and that property sold at a 5.8 cap, well, now I can apply that market cap in those averages, it would be 6%, and figure out what is the value of this property, because I know the income, I know the expenses, I know the NOI, and I know that all properties are selling for a 6 cap. So at that point, you can reverse the math and figure out how much the property is worth. To answer your question, the market cap here right now is somewhere around a 5, and that is on a downward trend because of all the factors we talked about earlier in the call. Demand is through the roof, interest rates are at historic lows, inventory is at a historic low, and prices are going up 20-30% year over year. So our market cap, 3 months ago, I'd have been comfortable saying 5. Right now, 4.8, something like that. It's a 5 on a downward trend. As the market, I don't want to say crashes or takes a downturn, but as the market kind of stabilizes and goes back to more of a normal trajectory, historically that has been closer to a 6. And so somewhere between 5 and 6, I think is realistic. You might find some stellar deal that'll get you closer to a 7, or you might find a 5 or a 6 cap that you can reposition, to a 7 or better. But realistically, at acquisition, somewhere between 5 and 6. Does that answer your question?
Yeah, great. Thanks.
I did forget to mention as well that if you have a hard time keeping up with me, or you're somebody who likes to look at this stuff over and over again, 1, we will record this call and it'll be on our coaching page. But 2, I actually have a video version of this presentation that I did a couple of years ago, and you can find that at themultifamilyguy.com/metrics. But at this point, Jamie, I need your homework. I have a spreadsheet that I use, and I'm happy to share it with you because there's nothing proprietary about it. Like I said, this is all simple math, folks. It's addition, subtraction, multiplication, and division, and the formulas are industry standard. So you could put together your own spreadsheet with just some very basic Excel knowledge. But here's a glance at what it looks like. And what I like about using my own spreadsheet is you can edit it on the fly. If I want to add a third column there and do asking price, offer price, and pro forma, I just cut and paste and add another column. You can see on this one, we were adding in like, well, what's our refinance target and how much could we cash out? And what about that? You can plug in some rehab estimates in the blank fields. So, you know, I just like the flexibility of having my own spreadsheet. I'll share this with anybody who wants it. Shoot me an email, jeff@copelandmorgan.com, and I'll share it with you. But what I'd like to do now is pull up my actual spreadsheet, and we'll plug in some of the blanks from the property that Jamie selected.
All right, so I've got a duplex in Tampa listed at 235.
And do you know what the monthly rental income is for all of the units?
2,100 for both units.
235K is the asking price. So that is our total acquisition cost. We're ignoring closing costs and stuff for now. Monthly income of 2,100 a month gives us, times 12 months, a potential gross income of 25,200. We're using 8% as our vacancy and collection loss, which gives us an effective gross income of 23,184. There is no HOA. We said management fees are 10%. We said taxes year 2 after the reassessment are going to be 3,400. We said the repairs, 5% of our effective gross income sounds realistic, 1,159. And now we're down to utilities. Do you know how the utilities are configured?
Electric is paid by each tenant separately, separate meters, so it should be 0
Okay, and that's pretty common here. It's often separate electric meters, 1 water meter is very common for a duplex. Now, keep in mind, when you have vacancies, you're usually going to put the electric back on in your name because you need to get in there and clean and do rehab and stuff like that. So, you know, you might want to pencil in a few $100 for electric here because you know you're going to have vacancies and you know you're going to put the power on. But for today's purposes, we'll leave it at 0. We'll assume it's fully occupied and we're going to keep it that way, you know, through year 1, year 2. Do we have any idea what the water, sewer, garbage expense is?
I do not.
So I would guess, and are these 1 bedroom, 2 bedroom, 3 bedroom units?
2 bed, 1 bath.
2 bedroom, 1 bath. I would say, you know, a family of 2 and a kid probably spend $150 a month on water. And I'm going to assume it also includes water, sewer, garbage. So $150 a month for a family of 2 to 4 people for water, sewer, garbage. Everybody agree that sounds pretty realistic? And that's going to vary from market to market. I'm just using what I know from here. So that puts us at $300 a month for the property times 12, so $3,600 a year. Everybody with me? What about insurance? Do we have any idea what the current owners pay for homeowners insurance?
No, it wasn't listed.
And that's pretty typical. And you want to be cautious too in using what the current owner pays, because they may have paid $100,000 for the property 10 years ago. And if they still have it insured at $100,000, they're underinsured based on today's market. So, you know, you can call your insurance agent and say, hey, could you give me a ballpark or a really quick quote on this duplex at 123 Main Street? And they might get back to you in a day or 2 and say, oh, yeah, it's going to be, you know, $3,000 a year or whatever. And typically with a duplex like this, if you're not going to be living in one unit, you're going to be renting them out. You don't need any contents coverage because that's going to be covered by the tenant's renter's insurance. You're not on the hook for their stuff. So say you exclude contents and just have, you know, your standard other, you know, liability and property casualty insurance. I would say something like $2,500 a year for a duplex. Duke or Luke, Doug, Obed, you guys agree that sound about right based on your recent experience?
Yep. That's right on target.
And
yeah,
then
Jeff, one of the things that I do for insurance, and by no means is it accurate, dead accurate on it, but I multiply your purchase price by 0.00075, and that at least gives you some kind of an idea based on purchase price. I had an insurance guy that did that for me because I was trying to put some kind of a calculation in there and explained it to him, and that's what he came up with. And like I said, by no means is it an exact science, but at least for initial numbers, it gives me something in there.
No, that's good. That's useful. How many zeros?
And then
2 zeros?
3 zeros and then 75.
And that's
So
monthly?
0.00075, and then that gives times your sale price or purchase price, and that gives you at least a number to work with. Sometimes it's been dead accurate, and sometimes it's been a little less, and sometimes it's been a little more. So,
And is that supposed to give you a monthly cost or an annual cost?
and that'll give you your, I think it's monthly, and then I have it in my spreadsheet to multiply it out for the annual, so you can see what that is as well.
Yeah, so that would put us at 176 a month times 12 would be 2115 a year. So we're right in that ballpark.
Yeah.
Early on in the analysis, I would say aim high, plug in 2,500 just to be safe.
Right.
2-3 days from
And that's
now.
what I use it for, just to get a ballpark.
Yep. And then, 3-4 days from now, when our insurance agent gets back to us, we can plug in the actual number. Maybe it's 1,800 and it makes our numbers look better, but it's always better to be cautious up front. So everybody agree we should just leave $2,500 in there for analysis purposes and, plan for the worst and hope for the best. So another thing that a lot of people leave out is a reserve for capital expenditures. Capital expenditures are things like replacing the roof, replacing the HVAC system. Those are the two big ones. So I'll just leave it at that. Water heater, there's plenty of other systems, but it's not something you can avoid. You will replace your roof roughly every 20 to 25 years in Florida. And so if you don't budget for that when you're analyzing a property, you're going to take a hit, when that happens. Now, a roof may cost $8,000 on an average property. And I'm going to pull up my calculator again. And let's say the roof on this duplex is $8,000 and it's good for 25 years. That's going to be $320 a year that we need to budget for. It's not a ridiculous amount. But if we don't plug that in for analysis purposes, it's going to come back to bite you at some point. And keep in mind, that's a reserve. It's not an actual expense. It's just a way of normalizing your expenses on an annual basis. What's really going to happen is hopefully you plugged away $320 a year in your reserve account or in your operating account or whatever. And then 10 years from now, it's time to pay the piper, and you're going to stroke a check for $8,000 on the roof. But the key is to budget for capital expenditures, because you will replace the roof, you will replace the HVAC systems, and you will replace the water heaters. And there's a few other things on that list. But as you can see, when you normalize them over the lifespan of the equipment, it's not huge money, but you should plug something in there. I'm using 5% of effective gross income, kind of roughly the same as what the repairs are going to be. You should double down on that and put the other half away for CapEx. Now, keep in mind, even though you budgeted this in your spreadsheet and maybe you put that money aside, the IRS doesn't see that as an expense. You still have to subtract that back out when you do your taxes, because you have that money sitting in your account and the IRS sees it as income. But for analysis purposes on your operating statement, to normalize those capital expenditures, you should have an annual number plugged in. That makes sense? So we come down to total expenses, $14,137 a year. And look at that, 56%. That seems about right. We said it should meet that 50% rule, give or take. If anything, I would say the expenses look a little bit high on this property, but we've done our initial pass of the numbers on this property. And let me scroll down here a little bit and we'll look at some of our formulas. Let's start with the cap rate, 3.85%. It's not terribly exciting, but but it doesn't scare me away either, because this $235,000, I'm assuming, is an asking price. Is that correct, Jamie? So you or your real estate agent should be able to negotiate a better price. Now, it's easier said than done in this market, and I know you're all aware that the answer might be, hey, we have multiple offers and 6 of them are cash, and get me your highest and best by 5 p.m. tomorrow. But in a normal market, you should be able to even show this to the listing agent or the seller and say, look, I'm not pulling numbers out of thin air. I'm plugging in the expenses that you gave me, and I'm coming up with a 3%, 3.8% cap rate. That's not realistic when the market cap is a 5. So why don't you sell me this property for $199? And the cool thing about having your spreadsheet here right in front of you is all you got to do is plug in 199,000 up top, and now we see it jumps up to a 4.55% cap rate. So in a split second, I can figure out what makes sense as a purchase price for this property. 1% rule is right here as well. At 235, it was coming in at 0.89. That's pretty close to the 1% rule. So that initial screening, if I looked at this and said, well, you've got $2,100 a month in income, 235K purchase price, that's not quite 1%. I can do that in my head, but I probably would have said, well, that's close enough. That's the 0.9% rule. Let's analyze this property a little further. And you can see that this is what we came up with. So we're close on the 1% rule. We're kind of close on the cap rate. Now, let me ask you this, Jamie. Is this property like turnkey, fully rented at maximum market rent, or are those 2-bedroom, 1-bath units maybe below market a little bit?
I didn't actually check what the market rent would be in the area. Just
off the top of my head, I would say that 2-bedroom, 1-bath units in a decent neighborhood in the Tampa Bay area should be getting $1,200, $1,300 a month. So what if we had $2,600 a month in rental income? How does that change our outlook? Oh, now we're at a 5.7 cap rate. Well, what if we got it for $199 and we got the rent up to $1,300 a month? And I'll look at that. Now I'm at a 6.7 cap rate. I could sell this all day long at those numbers. But what this enables you to do is to just plug in those numbers and figure out, well, what if I got it for less? What if I rented it for more? What if I got these expenses down? What if I charged $20 a month for the laundry room? What if I charged for the garage storage? You can either increase the rent or you can decrease the expenses. Those are the 2 ways to improve a property's performance. And so the other thing that I like about this is I can just plug in these same numbers. I'm going to put this back to 235. That was our analysis, and 2,100. So that gets us back down to the 0.89 and the 3.85. So over here, I'm going to say, well, what if I paid $205 for it, and I ended up getting $2,250 a month in rent? So my income looks better, and in terms of my expenses, that's a formula. That's a formula, which is about the same. That's a formula. Water, sewer, garbage we plugged in. Now let's say this. I'm going to build a water, sewer, garbage back to the tenants in year 2. When I turn over the leases, I'm going to say, hey, Mr. Tenant, congratulations, you're paying $150 a month for your water bill. So that becomes a 0. Insurance, we'll keep at $2,500, and we'll keep our reserve for CapEx the same. And now look at that. If we bill back the utilities and pay $205 and get the rents up to $2,250, now we're at a 40% expense ratio, 1.1% rent to acquisition, the 1% rule, and a 6.77% cap rate. So hopefully just that little quick example showed you the power of having a tool like this that you understand and you can edit and plug in and change on the fly. Because it lets you really, really quickly figure out what makes sense for this property. What if we got it for less? What if I rented it for more? What if I got rid of that utility expense? and how does that change the outlook of the property? So you might have to pay 235 for it, and it might look like a 3.8 cap in the first year that you operate this property. But if you did nothing else but delete that $3,600 a year in water, sewer, garbage, even that gets you up to a 1% rule and a 5.69% cap rate. So it enables you to come up with a game plan for the property, and you can see, well, it's not a home run at closing. I have to pay 235 because there's multiple offers and I don't have any choice, but you're not stuck at a 3.85% cap rate for the rest of your life. Literally, the first time you renew the leases, you can say, you know, now the rents are $11.25 each, and you're going to pay $150 a month towards your water bill, which makes this a 0. And now in year 2, this property is performing quite well, above average, almost a 6 cap, and it's hitting that 1% rule. Now, the other thing I did on this spreadsheet is I plugged in some numbers here at the top for financing terms. So let's assume it's a duplex. You're going to get a 30-year fixed rate mortgage. Your interest rate right now on that is probably going to be closer to 4. So let's say you did 4%, and let's say you're putting down the standard 25%. So now if we go back down, we can look at our financing numbers. Yeah, on 235, you're going to have a mortgage balance in year 1 at 176,250, and your year 1 debt service is going to be about $10,000. Your principal and interest payments. Remember, we already included taxes and insurance up here, so we really only have to worry about the P and the I down here. So before taxes, your cash flow is actually going to be negative. But remember what I said about CapEx? They don't actually count as expenses. So you got $11.59 penciled in up here for CapEx. You've got negative $1,000 cash flow down here, but really you're going to be cash flow positive about $100. You're just not going to have any reserves. So you could survive year 1 in this scenario, and then you're going to project into year 2 what your plans are for the property in terms of rental income and expenses. Our debt service coverage ratio here would be a 0.9. That's not great. That means, again, we're losing money every month because we're not bringing in enough net income to cover the debt service. Now, if just for giggles, I said, you know what, I'm not going to be able to reserve anything in year 1. Let's take out the reserve for CapEx, and we'll start that in year 2. I make that a 0. And now you can see, okay, now I'm $100 cash flow positive. And because I just barely break even, my debt service coverage ratio is a 1. So the property carries itself in year 1, but I see the opportunity, I see the changes, I see the path I can take in year 2. And now we can look at our year 2 numbers. Debt service is the same, and you generally just use your year 1 debt service. It's going to change a little bit based on your amortization table, but not much in year 1, year 2. But over here in year 2, remember, I raised the rents by like $125 a month. I build back the utilities. Now I'm almost $3,300 cash flow positive. My debt service coverage ratio is a 1.32. If this were a commercial property, I could get a commercial mortgage on this all day long at roughly 25% down, the 75% LTV. Those are the numbers we're using. And now here in year 2, my break even is 80%, 79.85. So with 80% occupancy, I'm still break even. And the cash on cash is much better here. It goes up to almost a 6% cash on cash return. And so you can see just by making a couple changes, if I raise the rent and get it up to $2,250 instead of $2,100, and if I get rid of that darn $3,600 a year utility expense and bill that back to the tenants, it changes everything. Now, what if I could actually buy it for $220 instead of $235? Now, what do my year 2 numbers look like? Sorry, I put in 220,000. You'd still have to key in the right numbers for it to make sense. So now I'm at the 1%. I'm above a 6 cap and 1.35. So it doesn't change your numbers that much. And you can tell here in this year 2 analysis, between a 220K purchase price and a 230K purchase price, it doesn't make a ton of difference. I'm still right around a 6 cap. I'm still right around a 6.6 cash on cash. My DSCR doesn't change a whole lot. So if you were in a bidding war on this property and you were at 220 and it looked like this, and then you plug in 230 and it looks like this, is that a deal breaker? Does this still look good in year 2? Would you pay 230 instead of 220? This tool allows you to do that kind of stuff on the fly and figure out what makes sense based on your specific plans for the property. So I know that was a lot to take in, and I know I went fast in the interest of time. So I'm going to stop there and open it up for discussion. Go ahead, Stan.
Yeah, if I buy into a new development and, it has the warranty in there, should I lower my repair and CapEx percentages?
Yeah, I mean, I think you can adjust that based on the best information that you have available. I'm not a huge fan of home warranties, but if you're talking about new construction where the builder has a lot of the components under warranty for the first 5 years, then sure, you can definitely reduce CapEx for those first 5 years or reduce your repair costs, hopefully near zero in the first 5 years. And you might want to reduce your repairs, but bump up your reserves. You can adjust all of this based on the situation. Every property is different. Every market is different. And so I really think that's the beauty of understanding these numbers and understanding how to use this tool, because it allows you to adapt it to different situations. That's a great question.
So I see that like you have like the two different sides where you'd be like, what if this, what if that? Does it get to like a certain point where like you're doing too much to justify trying to make a purchase work? That's
a great question. It is a tendency that you have sometimes. You're like, oh, I really love this property. Maybe the taxes won't go up, or, oh, maybe I can get cheaper insurance. And, maybe it's not realistic to charge the tenants $150 on top of the rent. I was just using that, for utilities. I was just using that as an example. That is a great question. And I think really only you can answer this question. Like, am I fudging these numbers too much just to make this deal work because I like it? Or am I being hard and analytical and running this property through its paces to make sure that it makes sense for me? That is something to be cautious of. At the other end of the spectrum, though, is analysis paralysis. People just like to crunch numbers and analyze properties, but never buy anything. And just remember, there is always an opportunity cost to doing nothing. There are dozens of properties that I passed on 3, 4, 2 years ago that, we're kicking ourselves now for not buying them then. And to some extent, we'll be doing the same thing 5, 10 years from now. Oh, I wish I bought that duplex for $235. Now, at the same time, I don't have a crystal ball. Maybe the market does crash in 2024. But that's where this analysis is so important, because if you get down here to the bottom and you're cash flow positive by $3,300 a year after paying debt service, you almost can't go wrong, because you can even come back up here and say, well, what if the bottom falls out of the rental market and my rent goes back down below where it is today, and now I'm only getting $2,000 a month? You're still cash flow positive. So you can plug in those stressors here on the spreadsheet and say, well, what if things look rosy? What if things don't look rosy 3 or 4 years from now? Am I going to be shoveling money into this property, or am I still going to be cash flow positive? And in this scenario, if you can get rid of that utility expense, that really is what puts this property in the positive. Is, we were $3,000 positive after deleting a $3,600 expense. And so, this is a hypothetical, so I can't tell you for sure that the tenants and the market would bear that. But it does enable you to plug in the good, the bad, and the ugly and figure out what makes sense. But ultimately, it's all about, it's garbage in, garbage out, or quality in, quality out. If these expenses and income are accurate, then you can have a lot of faith in your estimates and in your numbers. If you're plucking numbers out of thin air, then it's going to be, you're going to have less confidence in it, just like anything else.
Where does, let's say I'm a buy and hold investor, and I might find a property that doesn't cash flow that well, but I see potential appreciation. Where does that come into play?
Yeah, that is an excellent question. Nothing in here accounts for appreciation. And I think the answer, or the tact that most people take, is you buy for cash flow and you make sure your cash flow is solid, or at least solid enough to cover your debt service and keep you in the black. And if you bank on 10 or 20 or 30% appreciation on top of that, that's your cherry on top. At the same time, like Jamie just mentioned, or we talked about with Jamie, what if the market declines? Well, even at lower rent amounts and keeping the expenses the same, I'm still cash flow positive on this property, even if the rents go down to 2,000 instead of 2,250. And so it kind of goes both ways. If the appreciation comes, great, that's gravy on top. If the appreciation doesn't come, or if the property declines in value, you're still cash flow positive, and you can ride it out until the market comes back 5 years later. And that's why the cash flow is so important. It enables you to navigate or maintain throughout the ups and downs of the market cycle.
Okay, great. That answers my question.
Hey, you guys have been a great group. Jamie, thank you for picking the property for us to analyze. If you want to copy the spreadsheet, if you don't already have it, shoot me an email, jeff@copelandmorgan.com. You can find the video version of this at the multifamily guy/metrics. And this video itself with our beautiful faces on it will also be in our archives page probably one day next week. So thank you all for participating. Have a great Memorial Day weekend, and look forward to talking to each of you soon.